everyone for coming. So Karin, you met and she walked in, and I are both with Berkshire Hathaway, and we're both super passionate about investing because we're both investors and have experienced the benefits that it can bring you. And we got into this because we kind of just did it and made some, gut decisions, and we're like, there's not a lot of training around this. Let's offer it. And so we're bringing in great guest speakers like we have tonight. We've been doing this for about 1.5 years. I'm gonna skip some to get so we have good information. Just so for those who haven't been before, this is what Karin and I's 5 steps to successful real estate investing. We offer this investor education every month, the second Wednesday of the month in this location. We offer investor consultations, which will sit down with you for an hour and help you map out what are your goals, what are your hurdles to investing, and figure out a plan to move forward. We have an investor analysis sheet that you can plug in all your numbers for a certain property. Once you've identified what your goal is, make sure that it meets all your number goals. And then we also do real estate reviews to analyze your property, whether it's a rental property or your own home. We'll let you know what the current equity is in that property in case you want to use it to pull, a loan against or to purchase future rental properties. So we offer all those are free offerings if you're interested. And next class, best practices for managing rental property. This is a good one. We have our special guest, Eric Krauser. He's with Advanced Property Management. So that'll be next August 9th at 5:45. If you're not on our Facebook group, this is where we post the videos that we record. So you're can get that at the end if you'd like. And so now we're gonna pass it over to Michelle to get started. Woohoo! There we go, and then I'll just show you.
Show up very well.
Is it good?
Yeah.
A little bit?
Yeah, I don't know where the green comes from, but hopefully you can see it. If not, I'll just read it out loud.
Okay, do you want to take this position and to control, because I don't have a beeper thing? Okay.
Well, I am really, really excited to be here, as I'm sure you are, because we're talking about your favorite subject, right? Taxes, everybody's favorite subject?
It's
Well,
mine.
Nope.
It's definitely my favorite.
I promise by the end of our class today, it should be or will be. So I love Berkshire Hathaway and the fact that they bring these types of classes to you. I've taught in this market center multiple times, even just about the basics of taxes, but I'm really excited because tonight we're gonna talk about probably my favorite subject on the planet. Well, next to my dogs. They might object if I say that. Second favorite subject on the planet, which is taxes or investing in real estate, and how the amazing ability of building wealth and minimizing taxes when you do things a certain way in a certain order. So I'm going to stop for a moment because I want to find out from you what you want me to talk about. What kind of things are you wanting to hear about in this class tonight, in this presentation? Short-term rental? Long-term rental? What other things do you like? Write-offs?
Any new tax code this year that applies to real estate?
I don't know what's going on this year, but a friend of mine was pretty upset with some of the legislation that's coming and that's gonna put a damper on people and their ability to raise rents, licensing, things like that.
Licensing, and now landlords are gonna have to do all these additional things to make sure their homes are habitable by definition, which then is gonna cause landlords to raise their rents, which is then gonna cause people to pay more money to rent property, and rents are already super high in Colorado, just like the pricing of homes is high. So it's just gonna put a bigger burden. I still don't think it's gonna deter people, but we're gonna see an increase in rents, not like a decrease or anything like that. That's a good question, right? What kinds of things are going to affect the rental market? The rents you're gonna be able to collect, the money that's gonna be coming out of your pocket for those expenses, or you're gonna pass them on to tenants like you might utilities, etc. Pet deposit, pet fees. Anything else you want me to cover? I'll touch upon cost segregation. I think that's important that you understand what it is.
I have no idea what that is.
Yeah, I think a lot of people don't understand that. So
Sweet.
detailed, it's a huge opportunity.
Yeah, and I only have 30 minutes and I like to talk, so I want you to be interactive, ask questions. I might say something you don't know or don't understand. Please don't be shy. I could just be talking blah, blah, blah up here. If I do, stop me and say, wait a minute, what in the world are you talking about? So, my name is Michelle. I'm a CPA. I have a master's degree in taxation from DU, also a certified tax coach. So what that means in English is that I've studied intently the tax code, regulations, procedures, tax court cases, etc. And I've taken and extrapolated things from that and put together, that's how tax compliance, tax strategy is put together. And the reason I guess I gravitated towards this, I'm not entirely sure why. I was a tax advisor for one of the largest real estate investors in Denver. So I got this amazing insight into real estate from a tax perspective. And kind of, 7 years into working long hours, all year round, I didn't know what I was gonna do. And my mom happened to read this book called Rich Dad Poor Dad, which, by the way, happens to be up front here. If you haven't read this book, I strongly recommend it. There are some incredible things in there. What I like about it is you could scratch out real estate and it really does apply to just about anything. But what I really like about it is the content and the things that you learn from it. Read the whole series. Don't stop with the book. There are so many other books in this series about real estate investing and landlording, etc., that it's super beneficial. So if you can't read this, I've got a link up here. If you want to book a free consultation, it's a site that you can go to. So I'm going to just kind of get started. And I told you a little bit about me. Certified public accountant. I am also a realtor, so I speak your language. So I understand what you're going through, the steps that you're taking, the problems you're facing. And I also have this great background in tax, so it works really well together because we speak the same language. So my goal is to build what help you help your clients build wealth through income producing assets, such as the businesses that you own and the real estate that you own. So we're gonna kind of jump right into it, because if we're talking about real estate from a rental perspective, income producing assets, we're really focusing on one code section of the IRS tax code, which is section 469. Talks about passive activity losses, or the passive activity rules. Now, if I'm thinking about real estate, rental real estate, it is a passive activity. Am I really doing anything to earn the income that's coming in? Not really. I have an asset and somebody is paying me to use that asset. I'm not actively seeking that income like you might be as a real estate agent, where you're going out, showing homes, writing offers, under contract, and everything that you do through the process, or even on the lending side. So
Yeah,
from
can I just, real quick, so most of these people are real estate investors, not
Okay.
agents, so just so
Good.
we focus on that kind of
Thank
more
you.
than. Yep.
So when we're talking about code section 469, rental real estate is passive income. There are differences in the way that income is taxed if it is active income, like a trade or business, or a short-term rental, potentially, and passive income. The problem with passive losses is that they're generally not allowed to be deducted against active income unless you meet certain criteria. So section 469 has a lot of really good information that does affect you as investors. Now, there's three main parts to 469. There's the general passive loss limitations, which essentially says a passive activity loss cannot offset active income. But then there's a part that says, well, if you're more involved in that activity, maybe some of the losses that are created from these activities may offset some of your earned income. And then there's a part in there that says, hey, you're full-time real estate. This is all you do. It's called real estate professional status. And then it doesn't matter what kind of losses you create, they're always going to be allowed because you're a real estate professional. So section 469 of the tax code is really important. So I'm going to start with what I just talked about, real estate professional status. Because if I'm spending more time in real estate than any other activity, that's what I do, right? I don't have a second job, W-2 or anything like that that takes up my time. More of my time is in real estate than any other activity. And there are certain activities that qualify, certain activities that don't. For example, real estate agent, active business, going out helping to facilitate buying and selling real estate qualifies as a real estate professional. A lender who may be lending funds for a real estate transaction does not qualify as a real estate professional for purposes of Section 469. So there are subtle distinctions depending on the time and activity that you're providing, whether losses that you ultimately end up creating in rental real estate that may or may not be able to offset income.
So question on that, because I get this a lot from our clients. Do you have to have a real estate license to meet that? Or if you just have a whole bunch of properties and you're managing your own properties and that's all you do, you don't have another job, do you meet that?
So, great question, Amy. Do I have to have a real estate license to qualify? And the quick answer is no. I just have to do certain things. More of my time has to be in real estate related activities than anything else. So if I have a full-time W-2, let's just say I'm a CPA, and I happen to have some rental properties. Do I qualify as a real estate professional? Well, the answer is it depends, but more likely not, because I have to have more hours in real estate than any other activity, and I have to have over, or at least 750 hours of services in real property trades or businesses. Here's the problem. If I work a full-time 40-hour week W-2 and CPAs don't, but some individuals do work that traditional 40-hour work week, you would literally have to work 41 plus hours on average in real estate related activities in order to qualify as a real estate professional. This is a highly audited area. So Code Section 469 of the tax code is one of the highest audited areas of the entire tax code. Because everyone wants to invest in real estate, it creates losses. I have to pay less taxes, that offsets my income. But the reality is, think of it this way. If I'm a trader business and I'm having a bad year, sales are down, I have losses, I should be allowed to take those losses, right? That's my business, that's what I do. And that's the same thing in real estate. However, if I'm a receptionist full-time and I have some real estate investments, am I invested in real estate? Is that my primary activity? And the short answer to that is no. And so the same benefit does not apply that it would to somebody that is actually in that industry. So if I'm a business owner, I would be upset if somebody told me I couldn't take my loss. Just as I'm a real estate professional, I should be allowed to take my losses. This is what I do. But somebody who is only part-time in real estate or does something full-time and they just don't have that much in rental activities or the time invested in rental activities, it's not your primary source of income. And the IRS says you can't benefit from the losses that those investments create. So that's why we're here. What we want to know is, what do I have to do in order to qualify? Because part of the benefit of real estate is those losses offsetting earned income. W-2 income is one of the hardest types of income to offset, because if you look at the tax code in totality, there's very few things in there that can help you reduce W-2 income. The tax code is written for business owners and real estate owners. So if I'm looking at, well shoot, how do I minimize my tax liability, reduce my income, and I'm a W-2 earner, there's very few things I can do. It's the big reason why Code Section 469 is such a highly audited area. The IRS knows this. They have rules. So in general, as I mentioned in the beginning, losses get created. Maybe I can take those losses, maybe not. But real estate professional status means, hey, I'm doing this full time. Now, full time doesn't mean 40 hours a week. If I'm not doing anything else and I put 20 hours into real estate, as long as I hit that 750 hour mark, and it's more time in real estate obviously than anything else that's income producing, I'm a real estate professional. Now, 750 hours is roughly 1/3 of the year. That's actually a decent amount of time. But what happens if I don't hit that 750 hour mark? Is there an easier way to potentially take losses? So I said there's like 3 sections or 3 parts to section 469. And real estate professional status is the 3rd step. The 2nd step is something called material participation. It's not as stringent. Now, material participation is ultimately one of 7 tests. I only have to hit one of these 7 tests, and I'm materially participating in my rental activity. Therefore, I may not get to deduct all of my losses, but I can deduct up to $25,000. So I get something, right? I'm not as actively involved as I could be, but hey, I didn't meet the 750, or I'm not gonna meet that much time, or I do have some kind of other position or income source. I have a less stringent requirement that I could meet, and I still get some benefit from the loss. So there's the 500-hour rule. Now, I'm talking about hours, so obviously I want to touch upon the fact that you should have a time log. Because how else are you going to identify the time that you're spending on your properties to show that, yes, I'm a real estate professional, or hey, I'm materially participating? Now, this test is a requirement for both long-term and short-term rentals. Real estate professional status is only for long-term rentals. I know a lot of people get confused by that. So there's actually 2 tests that I have to be meeting on the real estate professional side. I do have to be materially participating, but the reality is if I'm putting in 750 or more hours, I obviously have to be materially participating, but the second part to that was, it has to be more hours than anything else. So hey, I don't quite meet that, but at the same time, I still am actively, materially participating in my rental activities. I should be able to deduct something. And that's this test, material participation. Questions so far? Is this good stuff? Is this new information, or have you heard it before?
This is all new for me.
Okay.
And this changes, how often do you say that, because the tax law around this changes and whether they allow this or not, depending on kind of who's in office, right? And who, if they're real estate friendly. How often would you say that they change these rules around?
Well, I wouldn't say they change it directly, but I think it's more of what kind of qualifications are you providing, and that's why I mentioned time log. Because
the time logs didn't exist like 5 years ago, right? That you had.
well, they technically always did, because how else are you going to show the IRS that you've documented the time that you're spending?
True, but they didn't
and I'll tell you one thing: if you want a shortcut to everything I'm going to talk about, just do a Google search for the audit guide on rental real estate. The IRS publishes all their audit guides. It's open to the public. It literally tells you what they're looking for when they're auditing you. So a helpful little guide, because it might tell you some things that you might not have known. Now, the time log is important because I need to somehow document all the time that I'm spending on my property, because I might sell 1 property a year and hit that. Am I going to hit that 750 hour mark? Maybe, maybe not. I'm a super active, real estate agent. I'm in real estate related activities, or I'm a real estate developer. I'm developing properties. I have to document somehow that I'm doing direct activities to real estate that will hold up in an audit. Now, the reason I say you have that time log is because there's 2 sets of rules, one for short-term rentals, one for long-term rentals. You end up having 2 logs, and you're essentially going to batch or package all your long-term rentals into a time log and short-term rentals. Now, I generally advise you to have a time log for each property, and then you can document exactly how much time. Now, for the time rule, there is a way that you can elect to treat all of your rental activities as one. Now, by one, I mean all long-term rental activities as one, all short-term rental activities as one. Because imagine having 10 rentals and having to hit 750 hours on all 10 properties. It's physically impossible, right? But yet we have people that own multiple properties. So there is a grouping election that the IRS allows that says, I'm grouping all my activities as one. Therefore, I only have to hit that 750 hours 1 time. Makes sense? Makes things a lot easier. So now, taking this a step further, let's look at these individual tests, because some of them sound simple, and I'm gonna point out the ones that apply to short-term rentals, because we're gonna talk about short-term rentals in a minute. But material participation. So we were just talking about 500 hours, that's the very first one. Well, I've materially participated in the activity for more than 500 hours a year. Check, that was easy. Or, because I only have to meet one, I don't have to meet all of them, I only have to meet one of these tests. Or, my participation in this activity, or activities, for the taxable year constitutes substantially all of the participation in the activity for of all individuals. So it's my properties, no one else is involved, like contractors, cleaners, etc., and all of my time essentially is in this activity. That's number 2. So number 3 is a less stringent rule, and you see this met more often in the short-term rental side than the long-term rental side, is I just have to participate more than 100 hours during the taxable year and more than anyone else. Well, shoot, that sounds a lot more simple, right? But yet when it comes to long-term rentals, a lot of times you don't meet this standard. So what does this mean? Here's what it means, and especially for short-term rentals. I just have to put 100 hours or more into this activity and more than anyone else. More than the cleaners, more than contractors, etc. So it has to be mainly me. And you might say, what is the difference between number 2 and number 3? There's subtle differences between these. But that subtle difference can mean you qualify under this part of the material participation rules, or you might not. So additional ones, activity for the tax year, your aggregate participation in all significant participation activities exceeds 500. Sounds kind of similar. You're individually materially participated in any of the last 5 tax years. The activity is a personal service activity and you participated the last 3 years. And obviously, if you've had this rental for a long time, you might meet number 5 or number 6. But if this is your first year or second year in the property, you don't meet a 5-year rule, you don't meet a 3-year rule. So just check those off.
And these are just, like, if you meet 5, you don't have to
Exactly.
have
I just need to meet one of these tests.
Okay.
They're giving you 7 ways of doing it. And then obviously, based on all the facts and service circumstances, I participated on a regular, continuous, substantial basis. Now, do you notice how vague that is? Because what exactly is regular, continuous, and substantial? It's not defined. But go through an audit and then you'll know exactly what that means. So, material participation is part of the process when looking at long-term and short-term rentals, but real estate professional status is the additional requirement on the long-term side, not on the short-term side. I talked about some of these. So let's talk about what indications that you did not materially participate. So for example, you weren't compensated for services. Most individuals expect to be compensated for services. Obviously, your residence is located hundreds of miles from your rental property. How can you materially participate if you're that far away? Now, obviously, Zoom and online abilities have changed, but this is still relevant. This is what the IRS looks at and says, well, your property is in Florida, you're here, how can you possibly put in enough hours to materially participate in that activity? And more than anyone else. And if you have a property manager, that's an automatic red flag. Not an audit and not a loss in an audit, but it's an automatic red flag. Because again, we just talked about the material participation rules. If somebody else is doing all the work, how in the world do you qualify? And the easiest qualification is 100 hours and more than anyone else. Well, you better be documenting the time that property manager is spending on your property, and they are going to be doing that. Because, again, when you have these additional individuals involved, you're tracking it, but that's also decreasing the time you're spending on it. So you have numerous other investments, hobbies, other hobbies and things you're doing, health issues, things like that. Okay, so let's see if I can find this next slide, because I think I might have passed it. Let's see. Or else I inadvertently didn't include it in my slides, but that's okay. All right, I'm gonna move on to something called short-term rental loophole. So, anybody hear of this loophole? I mean, we like loopholes, obviously. 1031 exchange has some loopholes, but have you ever heard of the short-term rental loophole?
Is it the
From
14
you.
day?
Sorry?
Is it the 14-day rule?
Well, that's part of it, kind of, but not really. So let's think of it this way. So another subtle difference between long-term rental and short-term rental is the depreciable life of the asset. So short-term rental is, 30 days or less average rental. It's considered short-term rentals, right? My average stay is less than 30 days. That's also considered commercial. And so it has a different depreciable life than a long-term rental. Now, a lot of people, you might hear the term midterm rental. The IRS, at least currently, does not recognize that. It's either short-term rental or long-term rental. So a midterm rental is generally anything more than 30 days, but say less than 90 or 180. It's not a long period of time, and then everything else is long-term. So there's subtle differences. So we just said short-term rental treated like commercial property. It's depreciated over 39-year life, more like a trade or business. Residential is anything more than 30 days, 27 and a half years, generally speaking. This is relevant because the number of tax preparers that inadvertently put a short-term rental as a 27 and a half year life is wrong. That's caught in audit. So the loophole says less than 30 days average rents, and your tenant rents from you average of less than 7 days. So if you look at all the tenants that have stayed in your short-term rental, and that calculation of the average stay is less than 7 days, this real estate loophole is for you. Because if my property does create a loss, and I'm materially participating, I can take that loss against my earned income, W-2 income. Because again, long-term rental has its own rules, short-term rental has its own rules. So if I'm renting on average to 30 days at a time to a tenant, short-term rental loophole doesn't apply. Passive activity rules still apply. The reason it's called a loophole is because when your average stay is less than 7 days, it's treated as a trade or business. And trade or business losses are generally allowed in the year in which they occur. So how do we pull all this together? So we have an idea of short-term rental and long-term rental, how that affects the number of hours we're spending, the deductibility of losses, etc. There's a strategy there. Because if I'm full-time in real estate, it would obviously be easier for me to have long-term rentals because I would pretty much automatically qualify as a real estate professional, put somebody in the property, have some nice rents coming in, more passive on my part, and I still benefit from the losses. I do not benefit if I have W-2 income. But hey, I have my job, I love it, I want to keep it. But I want to build wealth and I want to minimize taxes. I might be more focused on investing in short-term rentals and doing certain things in a certain order, such as year one, putting my time and energy into that property. Obviously searching the property, buying the property, those hours don't count. You have to own the property and then your hours count. But now that I've bought the property, there's some repairs and maintenance. I have to furnish the property, get it ready, get it listed. Now I'm communicating with potential tenants and getting them scheduled, calling the cleaners. That's a lot of work. So there's benefits to, obviously, the more work you put into it, there's more benefits. But here's what happens. Short-term rentals have a lot of setup, the foundation in a house is the support. Well, short-term rentals have a lot of work up front, getting it ready to be rented. So it's easy for you to hit that 100-hour mark. Years 2 forward, you've got it set up. It's a money-making machine. It's harder to hit that 100-hour mark. So you may qualify for the short-term rental loophole in year 1, but very possibly not in years 2 forward. But you're cash flowing, and I'll tell you, in a short-term rental, in most markets, you're outperforming the market. So long-term rental, I can put, $3,000, $3,500 into a property every month for rental income. That's pretty good. Covering my expenses in many cases, making a little cash flow because that's our goal. And maybe I'm netting $6,000, $10,000 a year after expenses. Not too shabby for not having to do anything. And I can potentially benefit from the losses. Well, A short-term rental, I'm renting it like at a nightly rate, maybe a weekly rate, and I'm turning over that property more often. Take your rental income times 2, 3, 4. Exponentially more revenue on a short-term rental, but you're putting in a lot more time and energy. So the payout's greater. Now here's what I love about real estate. Ultimately, there's 3 things to me. There's I'm buying the property, and obviously my goal is to buy low and sell high. So my property should be appreciating, should be increasing in value. My goal is that my rents exceed my expenses, and so my cash flow is there. So I'm making money, and cash flow itself is not a taxable event. And option number 3, or part number 3, which is the whole point of what I'm doing, is how can I take the most advantaged tax benefits? Reducing taxable income, which reduces the taxes that I pay, puts more money back into my pocket. I can now go and do the same thing again, right? Rinse and repeat. So what a lot of investors do, especially on the short-term side, is they spend all of their time and energy putting that short-term rental into service, hitting that 100-hour mark more than anyone else. Then, after the end of that tax year, then they hire the property manager, because a lot of times it's not 100 hours worth of work that they're going to do that year, and they're not necessarily going to benefit if there's any losses. Now, ultimately, it doesn't matter if there's income, obviously, even after depreciation, but a lot of times you see them to kind of slow down and back off because they're not going to hit that 100-hour mark. So if there's a loss, they don't benefit from it because they didn't have enough time put into it, because the property can now operate itself effectively. So the hours that you spend on it are significantly decreased. However, they're now focused on the next property. And now that I've done it, the very first one is by far the hardest. It's the one that you're learning the most, overthinking it. Now you've done it. And now you're seeing the cash flow, 2, 3, 4 plus times what it would be if it was a long-term rental. Putting that money back into that property maybe, or putting it towards another property. And then they're doing the same thing again. They're bundling their time, spending as much time as they can, hitting that 100+ hour mark, doing all the things they have to do, the losses that are generated potentially, now offset W-2 income. So hey, I'm making money, W-2, now I'm paying my FICA, Medicare, etc., obviously, but I'm not necessarily paying income taxes, or I'm paying substantially less income taxes. And I'm not just benefiting on the federal side, I'm also benefiting on the state side, because state income in Colorado, at least, starts with federal taxable income. There's no add back for the benefits that you took for your rental properties. So you just reduced your taxable income on the federal side and on the state side. So that's 20, 30, 40+% tax savings on your income. Sound good? Yes, sir.
Yeah, I just want to reiterate, I want to make sure I understood this right. So the W-2 part, you can offset the W-2 income only in the first year. From second year, this won't impact unless you buy a different property.
Well, that's kind of the gist of it. However, it's based on the time that you're spending in the property.
Okay.
So
if
let's
I
just
spend
say
100+ hours in the second year, it's still
Yeah.
applicable. Okay.
So, something happens and you have to do some repairs. What I'm talking about are the expenses that are directly associated, or the hours associated directly with the property and managing your property.
Okay.
So that's repairs and maintenance, improvements, collecting rents, having a conversation with tenants. It is not doing bookkeeping or administrative or investor types of functions like, hey, I'm gonna find another property. I should be able to use that time in my time log. No, it doesn't work like that. That time has to be specific to that property. So the reason I say that in years 2 forward, it doesn't always make sense that if there's a loss, you're going to be able to take that loss, is because once you set up your short-term rental, unless there's some catastrophic event, it's a lot harder to hit that 100-hour mark. Now, if you're self-managing it, it's possible. Now, again, I want to move on to depreciation, because this is really the reason that you end up in a loss on a short-term rental. So cost segregation and depreciation. So depreciation is ultimately everything has a useful life, and over time, there's wear and tear. And so the IRS allows you to write off that wear and tear over time. So essentially, I'm probably not out of pocket $100,000 on my purchase, but I could potentially write off $100,000 immediately because of depreciation. That's the power of depreciation. And even though it doesn't actually say in the code depreciation on assets is required, when you sell that property, you are required to add back depreciation that you took or should have taken as part of the equation of the capital gain on the sale. So even though it doesn't say that you have to take depreciation, it's just strongly recommended that you do, because you have to add it back later on and pay tax on it. So why not take it and benefit from it? I know that's kind of a sometimes misunderstood concept, is there's no requirement there. Well, yes, but you still have to add it back.
So depreciation is like really hard for a lot of people to understand, and it's really hard to communicate too, how that works. But what's the kind of, do we wanna dive into that a little bit further?
Maybe talk about like how that affects investment property versus primary residence versus primary residence with an ADU, because that gets complicated for.
Yeah, so let's further our conversation with depreciation. Because I bought this asset, it depreciates over time, it wear and tear, it's not worth as much as it was when I first got it. So I can write it off a little bit at a time. And the IRS assigns a useful life. So like electronics would be 5 years, the couch is 7, the automobile you drive is 5. Commercial real estate like this building is 39 years. The home office in your home that you might use to run your business or your rentals is treated like commercial, 39-year life. Or a residential rental is 27 and a half. So assets have this classification. And it basically says, and I'll just use the 39-year life here for the commercial property, $1 million. Well, I can write that $1 million off as a deductible expense over 39 years. So it dilutes the benefit, right? So if I bought a $500 sofa, I would think I should be able to write off $500. But in reality, I have $1 million asset, I don't get to write off $1 million of expense. I get to write off 1/39th. So it dilutes the deduction. The benefit is that I'm looking for massive write-offs. If I'm maximizing my time, real estate professional material participation, and I know that the losses that I'm generating will offset earned income, I want to maximize those write-offs, and that's where depreciation comes in. Because traditionally, I have to write everything off over its useful life. Again, 7-year, 5-year, 39-year, etc. But is there a way I can take a portion of that and accelerate it and write it off in year 1? And that's what cost segregation does. You see cost segregation in short-term and long-term rentals. Essentially, all it's doing is taking every component of that asset, breaking it down into its individual part. Appliances, furniture, carpet, window coverings. So if I had $1 million asset and I could only deduct 1/39th of it in 1 year, I kind of missed some of the write-off, right? But if I take a portion of that $1 million, and let's use a nice round number of like 200,000, and say, well, of that $1 million, that 200,000 was actually personal property, like the carpet on the floor, the window coverings, appliances, and so cabinetry, etc. So once you break that down, personal property per the Internal Revenue Code, when it's a useful life less than 20 years, can be written off in year 1. Now, it used to be bonus depreciation is what I'm referring to. It's been used over time to stimulate the economy. So for the last several years, it's been 100% bonus depreciation. So literally everything that I spent that was personal property with a useful life less than 20 years, I could write off in year 1. So that $200,000 I was just referring to, that a cost segregation segregated and said that's personal property, I now take a $200,000 deduction against my rental income. Now, do you think I'm going to end up in a substantial loss situation? Yes. But guess what? Short-term rental, less than 30-day average stay. Obviously, by tenants, I'm going to make sure my average is less than 7 days. Then those losses are allowed to be taken against my earned income, and maybe I have W-2 income. Now I just found a way that I can offset my income that would otherwise I really couldn't offset before. Does that make sense? Does that kind of help put this into perspective a little bit? So it doesn't matter if it's an ADU. It doesn't matter If it's a duplex, an upstairs, downstairs, long-term rental. My goal is determining if it's a short-term or long-term rental and what I have to do to qualify. So if it's a long-term rental and I'm a real estate professional, I know I will get to take my losses no matter what. I want to create losses. Short-term rental side, maybe I do have W-2 income or other sources of income that I wouldn't be able to offset otherwise. But I know the steps that I need to do and what kind of a property I need and what the goals are that I need to achieve. And obviously I want to do a cost segregation. Now I've identified all these additional deductions that are absolutely allowed to be written off in year one. Year one is the year in which you identify cost segregation as a benefit, not necessarily the first year you bought the property or put it into service. So 5 years from now, you could decide, hey, I should have done cost segregation. Let's go do it. Now the rules at that time for depreciation will apply, so it's whatever percentage is allowed, but this is the potential that you get. So if I have $1 million asset and I just found $200,000 of deductions that I can write off, I might have just wiped out any taxable income on my W-2 income. That's pretty substantial savings. And heck, in my example, I could have potentially had a loss afterwards and that would have carried over to next year and would have offset some of my income next year. That's how the tax code works. Yes?
How does this work for a midterm rental? Because with all the new laws and, everyone's trying to kind of get rid of short term, doing a minimum 3 months. So let's say if a person buys a primary house with like a walkout basement or something, or maybe like an ADU attached, same wall, right? Because detached, attached is a different one. So could you use the cost segregation and depreciation for the square feet of the ADU, or you can't because it's the same wall with your primary
Well,
house?
look at it more like units and not necessarily like property, because you don't benefit from doing a cost segregation on a primary. I mean, it's primary, it's personal. So you don't do a cost segregation on that. But if I can bifurcate my unit and say I don't commingle my space, right? So I don't have a room share, because again, that's personal space that I'm sharing and getting some rental income out of, that doesn't qualify. But let's just say we have this bifurcated wall, or it's downstairs in the unit below, the basement that has its own separate entrance, it's treated like a separate unit. So now, my primary residence, I don't get a benefit from it, but I might get a benefit for the space downstairs used exclusively as rental property. Does that make sense?
It has to be, that makes sense, but it has to be short-term rental, right? What if it's a midterm rental, then how would that work out?
So same thing. So we were just talking about, I'm not gonna go back, long-term rental. So I have 2 ways I can qualify. So midterm doesn't exist in the IRS tax code at the moment.
Yep.
I have to follow long-term rules.
Okay, so
Long-term
27
rules
and a
is
half years.
materially participating or real estate professional status. So if I hit either one of them, that might be a consideration. Now, if my loss is limited to $25,000 and I could have taken a $200,000 write-off, I might not do it. But real estate professional says it doesn't matter how much your loss is, take it, right? So if I know that I qualify as a real estate professional, I have long-term rentals, I'm gonna identify those properties and say, I'm gonna benefit from a cost segregation, which is going to identify additional depreciable assets that I can then offset my W-2 with. If I have short-term rentals, I'm gonna look at making sure that I'm hitting the hours and more than anyone else, and my average stay is less than 7 days. And then I know that I'm gonna benefit from losses. Now I can create losses with a cost segregation and offset my earned income. Here's the hard part though. What happens if I think or I know I'm gonna sell my property in 12 to 24 months? I mentioned earlier something called depreciation recapture. So let's just say my $1 million asset, I wrote off $200,000 of depreciation. So I just reduced taxable income, saved a bunch of money in taxes to now turn around and sell. Something called depreciation recapture. So if the formula for capital gains is proceeds less basis, and basis is the asset spread out over time, and I've already taken $200,000 of that basis as a write-off, I have to add it back. I can't double dip. That's depreciation recapture. That 200,000 becomes taxable. So that savings I got last year, I'm now paying back in the form of taxes. Didn't quite achieve what I meant. However, if I know I'm gonna have other sources of passive losses, I might still do it because I know it's gonna offset. Or if I'm gonna do a 1031 exchange, because what is a 1031 exchange? It's a like-kind exchange. I'm gonna sell one investment property and I'm gonna buy another. And I don't have to buy like for like. I don't have to buy land for land or sell land and buy land. I can sell a residential, I can buy commercial, vice versa. It just has to be real property. And I do this cost segregation and I save my $200,000 in additional deductions, I've reduced my income. Shoot, I decide I'm gonna sell, but I'm gonna do a 1031 exchange. Essentially, a 1031 exchange allows you to replace that property with like-kind property and defer the gain. So if my concern is, well, depreciation recapture, adding it back, now this huge taxable event, I benefited last year with depreciation, cost segregation. Next year I'm gonna sell, do a 1031 exchange, and I've never paid tax on the benefit from the 1031 exchange, or from the cost segregation, right? I rolled it into the new property. But what that means is from a depreciation perspective, the basis of the new property is now reduced by the gain that I deferred. And some of that gain is depreciation. Yeah.
On the cost segregation, is that something that you just do, or is that something you hire like a third party to actually do, like a study, I think I've heard about?
That is an awesome question. I'm so glad you asked. DIY, so to speak, or an actual company that specializes in cost segregation. What are the differences? Now the IRS will tell you in the IRS audit guide that there's no difference, they're still good, but when it comes down to, in an audit, defending a DIY, it's a lot harder, because a DIY is essentially taking a shortcut. DIY is do it yourself. It's basically saying, well, I think that the personal property 5-year life is 16% of my property. I think the 7-year useful life of assets is 20%. And I think the 15-year land improvements, which is essentially all the landscaping and everything outside of your house, of your building, that's 15-year. And it's assigning a percentage. There's no real analysis of the vitality of that. Now, a true cost segregation is done by a company that specializes in that. They have engineers that know how to price assets. They do an engineered study, they don't base it on percentages, and when you value the entire property, there's a scientific approach. That's the difference. Now, in an audit, the IRS will tell you, no, DIY, of course it'll hold up. It doesn't. Because when you pull out the percentages from thin air and say, yeah, that sounds good, that's normal, let's use 16%. That's a blanket statement for a property that may or may not qualify. Think of a condo. Condo, small little 1,000 square foot condo, 500 square foot condo. Do those percentages hold? Not necessarily. So the difference too, and keep in mind, when you're expending money to make money, and you have these deductions and expenses for your rental activities, those are deductible expenses, and people will focus on the $500 do-it-yourself and pay $500 and then not survive an audit versus the $2,000, $3,000, $5,000 professional cost segregation. It's still a write-off and it reduces your taxable income, but you have some audit protection. And guess what? Those DIY companies generally don't sign the report saying, we will defend you in an audit. But those companies that specialize in cost segregations generally will. They back up their work. Just like when I'm preparing a tax return, I back up my work. If the IRS, comes and says, we disagree with this deduction you took, that's on me to prove why I allowed that deduction. And I have to defend my position. Not all preparers do that, right? They prepare the return and say, good luck, you're on your own. But I defend my work because I know what I'm allowed and not allowed to do. Same thing in the cost segregation world. The lesser the cost is, the less you're gonna get out of it. Now you're gonna get a cost segregation, but the strength of that holding up in an audit is questionable. Yes,
You know typically how much those cost?
sorry?
How much the cost segregations cost if you hire someone who's actually gonna defend their work?
Yeah.
How much are they?
So for a lot of single family homes up to $1 million, like on the lower end, 2,500, on the higher end, 6,000 to 10,000. Commercial properties, obviously much larger, gonna take more time, more engineers involved, much higher cost. But they're relatively inexpensive
Compared to what, tax?
compared to the tax implications of the IRS stepping in and making your life miserable. And I can tell you, an auditor can go through, think they have a case, and they go through every little receipt, everything. And there's a lot of new auditors, and I'm not talking about the 87,000 number that gets floated around that may or may not be accurate. But what I'm saying is that they have all these new auditors, and either they want to prove themselves or they really have no idea what they're doing. Okay, let's focus on them not knowing what they're doing, because we know, like if you ever call customer service, you get answers, it's like, that's not even the right answer. That's what you're dealing with. And so they'll say, no, you can't do that. And you're like, wait a minute, yes, I can. And you have to prove it. So number one, ideally you want to avoid audit. And I'm not saying be so, liability or risk averse that you don't do anything for yourself, but understand that there are subtle things that you can do, like the type of cost segregation that's going to help shield you from some of that risk. Doesn't eliminate it, but just understanding the subtle differences in what a DIY is versus an actual company with an engineer, there's some credence behind that. Good questions. Yes?
So if you've owned a property for, let's say like 5-6 years and you didn't do the cost segregation, can you then do it?
So here's the benefit to that. We're not done with 2022 taxes yet, right? The deadline is October 15th. What if I had a short-term or long-term property that I actually hit the time requirements and I was intending on this, I just didn't know cost segregation was an option? I can still go backwards and do it. And here's why I would. The rules changed at the end of last year. It went from 100% bonus to 80%. What that means, in my example, 100% bonus depreciation, and I identified $200,000 of write-offs, depreciation I could accelerate, I could write off the whole $200,000. Well now, because it's now 80%, I can only write off 80% of $200,000. Still a pretty darn good number. So you bet I'm still potentially gonna do it, but next year it's gonna be 60%. It's getting diluted, and then the year after that's 40%. Now, I mentioned this before also, that bonus depreciation has been used to stimulate the economy, and that if I can write off 100% of something, it's gonna motivate me to go spend some money. If it's 30% or 0%, I'm like, I'm gonna hold on to that money. I'm not gonna benefit from it. A lot of people make decisions like that, right? Like, I own a business, I need to buy an automobile. Do I do it now or do I do it next year? Do I lease a car or do I buy it outright? And again, bonus depreciation plays into that. And it's not as easy as it used to be to be like, yeah, I should be leasing because I can write off more. Well, not necessarily. Bonus depreciation, I could potentially write off almost my entire car. So I buy this $50,000, F-150, I drive it 80% for business, and it's, 100% bonus depreciation. I could write off 100% of my business use. I could have written off $40,000 of my truck because that's how powerful bonus depreciation is. Pretty impressive, right? So just knowing those subtle little things, and yes, the tax laws change periodically. And so this year, we're halfway through and it's now 80% bonus that I can write off. Next year it'll be 60. That might motivate you to make some changes by the end of the year. You might need a new vehicle. You might be looking at another property. You have time on a cost segregation, you can do it after year end, but most deductions that we've talked about have to be done by the end of the year for a cash basis taxpayer, which investors and real estate agents traditionally are. If I'm a business owner, I'm accrual basis or cash. Cash is the money goes out, the money comes in, that's when I report it. Accrual basis is a little more complex in that it matches up the expenditure or the income to the period in which it was earned. So there's subtle benefits to having cash basis or accrual basis in calculating my net income or loss, But generally speaking, once December 31st hits, I'm significantly limited to the benefits that I can do. Cost segregation in retirement and limited parts of retirement are probably the only two real things that'll benefit me after the end of the year. Questions? More questions? These are great questions.
So this is the perfect time to be thinking of your tax strategy right now.
Think about this, right?
Not December 1 or December 15.
Yeah, now, we do a tax planning at the end of the year, and we do that intentionally because, again, we can make changes, we have some control as long as we do it by the end of the year. Another difference with a W-2 is I just get paid whatever I get paid, and I have not much I can do to write it, anything off against it. Business owner, real estate owner, I have time. If I know some of the things I can be doing, I might go out and do them.